Hello, everybody. Mr. Foley here. Today we are on part C, the stock market. Now, I hear about the stock market a lot, and it's a good thing to understand. And so that's why we're going to take a little bit of time with it, going over the basics um, and just seeing what it's all about. So here we go. All right, to begin, to understand why we need the stock market, we need to understand corporations. All right, so corporations an organization owned by many people, but the law looks at it as one person owning it. So basically, a corporation, what they want to do more than anything else is they want investors. They want people who will buy stock in their company. And so they sell stock, which is a part of their company, in order to make money. Okay? So for example, if you have 1,000 people each investing $100, you have $100,000 for your company. And the people that are investing the money are going to expect that they're going to make some money off of it. And you're going to use that money to make your company better. And maybe you're going to buy land, bigger factories, workers, equipment, whatever it might be. Well, you don't buy workers, but you hire workers. You know what I mean. Slavery's bad. So here's what we have. Let's pretend we are a car company. Let me move here a little bit. Whoa. Okay. You are selling stock, and selling stock could help you pay for the following. Maybe you're buying some trucks to transport your cars so they can get to the dealerships. Or maybe you need to buy the machines that are actually going to make the cars. And so corporations sell stock, shares of their actual company, so that they can get bigger. That's the idea. So purchasing stock. When you purchase stock, you're purchasing a part ownership in that company. And you have a very small bit of that company, but you get to share in the future profits. Okay? So scenario one, if a company sells 100 shares of stock and you own 2, then you own 2% of the company. So let's say there's 100 shares of Nike. It's not really, there's probably millions, but let's say there's only 100 shares. If Jim buys 2 shares, Jim owns 2% of Nike. He's pretty happy. And so when Nike makes money, he has a larger chance of having his stock prices rise. And if he sells them, he makes more money off of that. Now, a lot of times companies have what's called dividends. And that's the following. If the company makes money and has a profit, then part of the profit goes to the stockholders, the people that bought the stock, like Jim. So let's say this year Nike makes $10,000 in profit. Because Jim owns 2% of Nike in stocks, he's going to get some of that profit, which is pretty awesome. And so dividends usually pay out quarterly, so 4 times a year. If your company's making profit, you're going to make a little money, which is fantastic. So how do stock prices change things? Well, here's what we see. If the price of a stock increases, let's say Nike was selling for $100 for one stock, one share. Well, now it's up to $120 because people really want this company. That means that Jim's shares don't gain money. If each stock went up $20 per share, so you buy it for 120 instead of 100, if Jim sells his stock, he made $40 because his shares are each worth $20 more. However, the opposite is also true. If Nike shares decrease by $15 each, Jim's not so happy. All right. He's got 2 stocks, minus 15 times 2. He lost $30 if he sells his stock. That's no good. And let's say Nike goes out of business. Well, Jim's furious then. He's really upset. He owns 2% of Nike, but if Nike's worthless, his stock is worthless. So if he purchased a stock at $100, in the first scenario, each share is 100, he paid 200, he's going to get 240 back if he sells it when it's up 20. If he sells it when it's down 15, that was only $85 each. So he sold it for 170, but purchased it for 200, so he lost $30. If it goes out of business, he paid $200 for it. Now it's absolutely worthless. All of his $200 are gone. That money will not be seen again. So that's what we can see when the stock prices change. And the next thing you think about is what are the risks and rewards of purchasing stock? So why would you do it? Why would Jim want this stock? What is he hoping it will do in the long run? And what's the risk? You know, why do we see Jim with his unhappy face and crying? What does that mean? So selling stock. When you purchase stock, you can purchase it by yourself on the internet if you want to, or you can go through a broker. A broker is a person who acts as a go-between for buyers and sellers, because you're not going to go out there and say, hey, who in the world wants to sell me a share of Nike stock? Just not how it works. So what happens is you have the buyers on one end and the sellers on the other end, and they both go to a broker. And the broker figures out, all right, what do my sellers want to sell for? What do my buyers want to buy for? And makes the deal so it can happen. Because you can't have a sale if you don't have somebody buying and somebody selling. Okay. So I like the quote here. It says, we are the eyes and ears to our clients' stocks. And so if they're selling stock, they're trying to get the best price. If they're buying stock, they're trying to get the best price there. So that's kind of how it operates. Some brokerages are online. Some you can meet people in person. Just depends on the situation. And so a broker will take, say he has 100 people who want to buy a stock, and each want to buy 10 shares. So he needs 1,000 shares total. What he'll do is he'll buy all that at the same time if he can for the lowest price during the day, therefore getting you the best deal. And if he's selling, he'll try to sell for the highest price. Now, there's stock exchanges and over-the-counter markets. A stock exchange is when you have brokers at one location. The biggest stock exchange is in New York City. It looks something like that. And it's a huge place where people are selling lots of different shares of a ton of different companies. There's smaller ones as well. Chicago has one. So if 500 clients, let's say you have 500 clients from throughout the United States, and they all want to buy McDonald's stock. Well, the broker will take all of those orders and probably buy all that stock at once. Usually the stock market has larger companies that are there that are a part of it. So here's what we have. Your day at the stock market is 7 a.m., 7 to 9 a.m. The brokers arrive about 2 hours early to check out the news and see what's going on with trends. The stock market opens at 9:30, and the first 15 minutes are chaos. Brokers are contacting clients, they're recommending ideas, they're starting to buy and sell. 9:45, the algorithms and the computers take over for a lot of the trading to find the best deals and things like that. But the brokers continue to research and have meetings with different people to see what they want. 12 to 3:30, fit in lunch, meet with your clients, continue to research, call clients, attend meetings, all of that. And then the last half hour, 3:30 to 4, things get a little hectic with buying and selling. And so you take care of all that. Market closes at 4, and 4 to 4:15, you make sure that you have all your deals taken care of, that there's no problems. And so it's a lot of time. Part of it is the brokers doing their jobs. Part of it is algorithms and computers figuring out the best prices. So the stock exchange, like the New York Stock Exchange, here you can see people all over the place. They're talking to each other. They're buying and selling with each other. They're working the computers, all that. Now you also have over-the-counter markets. Oh, and by the way, take a look at this video. It's pretty interesting, and it shows you what the stock exchange is really like. Now the other type is over-the-counter markets, what's called NASDAQ. And NASDAQ is a computer-based system. And so all the stocks are bought and sold online. With the New York Stock Exchange, you can go to Wall Street, and that's where they're sold and purchased and all that. With NASDAQ, there is no place to go to. Everything is online. So what's it like? Well, here's a link. If you go to the Google Slides, you can watch that video. It kind of explains how it all operates. But you can tell here, it's a very electronic system to make that operate. Last thing to think about is that you cannot make a sale of stock if you don't have a buyer and a seller. It's like anything else. You have to have somebody who wants to purchase the stock. So last two questions, I believe, in your notes. First one, what will happen to the price of a stock if there are more buyers than sellers? So if more people want it than are willing to sell, what do you think is going to happen to the price of that stock? And second, the opposite situation. Let's say that there are a lot of people who want to sell it. There's not many people who want to buy it. What do you think is going to happen to the price of the stock there? So that's what we have on the stock market. That's kind of the basics of it. We could go into it for hours if we wanted to, but we just don't have that time. So if you have any questions, talk to your teacher, and we'll go from there. Have a good day, everybody.